Hey everyone, welcome to today's explainer. We're getting into something totally wild today, how Japan is basically the hidden puppet master of your money. I know, right now everybody is super fixated on those flashy, loud topics. AI bubbles, the latest political drama, but we're totally bypassing all of that today. Instead, we're uncovering what might actually be the most boring, yet absolutely crucial asset on planet Earth. And we'll see how it's quietly pulling the strings on your portfolio, your mortgage, and literally the entire global economy.
Okay, let's dive into this. Think about it for a second. What is the biggest hidden threat to the United States economy? Your mind probably jumps straight to, decisions made by the Federal Reserve, or maybe some sweeping legislation coming out of Washington. And hey, it's totally natural to think that the biggest economic threats are those loud, highly visible issues. But what if I told you the real answer doesn't start in Washington at all? Actually, scratch that. It doesn't even start in this hemisphere. It starts over 6,000 miles away, in Tokyo.
We are all so used to those highly clickable, loud threads that completely dominate our social media feeds. But hiding right there in the background is this incredibly quiet threat, Japanese government bonds. Now, I know that sounds incredibly dry, but the reality here is that the country we all know for amazing tech and pop culture, they've actually been the financial duct tape quietly holding the entire global financial system together for the past 30 years. And the fascinating, and honestly slightly terrifying part, that duct tape is finally starting to peel.
So, to really grasp why Japan is just so pivotal here, we've got to rewind the clock a bit. Let's go back to 1992. That was the year Japan's massive asset bubble spectacularly burst. Real estate collapsed, equities completely crashed, and Japan entered what economists call the lost decades. We are talking about a multi-decade period of essentially zero real growth, zero inflation, and completely stagnant wages. It was literally like the entire Japanese economy just hit the pause button. So fresh out of conventional options, the Bank of Japan did the only thing they really could do. They cut interest rates to zero, and eventually they even went below zero.
But here's the thing. Just hitting zero wasn't enough. So they introduced something called yield curve control. Now, yield curve control, or YCC, I know it kind of sounds like a Marvel supervillain, but it's actually just a central bank policy that explicitly caps long-term bond yields. The Japanese government essentially took superglue and pinned interest rates to the floor, regardless of what the broader market was doing. And by doing this, they effectively trapped domestic Japanese investors. Imagine being a massive pension fund or a life insurance company sitting out $1 billion portfolio, and your own government's bonds are paying you exactly 0%. You've got to find a way to make money somehow, right?
So, faced with literally zero returns at home, these massive Japanese institutions really only had one viable option. They had to go shopping overseas, and man, did they ever. Japan went on this huge, multi-decade global shopping spree, buying up massive amounts of foreign assets. They became the largest foreign holder of U.S. treasuries, a massive buyer of U.S. mortgage-backed securities, and ultimately the world's largest net creditor nation. Basically, without anyone really noticing, Japan became the world's ATM. They pumped trillions of dollars of liquidity into the global financial system simply because the math forced them to do it.
And that exact math created one of the most powerful financial forces in history. Let's look at how this actually works. Meet our theoretical investor here. Let's call him Bob. Bob realizes he can execute what's known as the yen carry trade. It's pretty simple. Step 1, Bob borrows money in Japanese yen at a near 0% interest rate. Step 2, he converts that yen into US dollars. Step 3, he takes those dollars and buys US treasuries that are yielding, let's say, 4%. And finally, step 4, after paying some minimal fees, Bob just pockets that 4% difference. It was basically free money. And this step-by-step process turned into a multi-trillion-dollar source of global liquidity.
Just look at that massive spread. It was an absolute no-brainer. When your borrowing cost is zero, you don't just stop at safe U.S. treasuries. Oh no. Investors took this super cheap yen and bought tech stocks, they bought real estate, they poured it into emerging markets. Honestly, if it had a pulse and yielded anything more than 0%, global investors were using Japanese money to buy it. And this dynamic naturally inflated asset prices all across the globe for decades.
So the end result here is that global markets were essentially running on Japanese Wi-Fi. This liquidity, it was totally invisible to most of us, but it kept everything connected and moving at lightning speed. But, and this is a massive but, this entire global financial hack relied entirely on one single, absolutely critical assumption, that Japanese yields would stay at zero forever. Because, think about it, if the cost of borrowing that yen ever went up, this entire multi-trillion-dollar trade would suddenly start to fracture.
Which brings us to the twist where the math finally flips, leading to the 2024 shockwave.
In 2024, that fundamental assumption finally broke. After decades of zero rates, the Bank of Japan officially ended its yield curve control policy. They finally scraped the superglue off the floor and raised interest rates for the very first time in 17 years. And then, shortly after, they actually raised them again. Well, the global reaction was immediate and it was violent. The S&P 500 dropped 6%. Over in Japan, the Nikkei 225 plummeted over 12% in a single day, which was its worst drop since 1987. Why? Because all of a sudden, borrowing in yen was no longer free, and trying to hedge against that currency risk became incredibly expensive. The free money trade was officially over, and investors were suddenly scrambling to unwind their positions before they lost their shirts.
Now, what is really fascinating here is the massive shift in capital flows. Under the old math, money was constantly flowing out of Japan to fund the rest of the world. But under the new math, we are seeing massive repatriation. Because domestic Japanese yields are finally rising, all that capital is packing its bags and heading right back home to Tokyo. To put it simply, the absolute cheapest source of global liquidity for the past 30 years is officially closing up shop.
Let's talk about why long-term yields really matter, and why we need to stop staring at the Federal Reserve.
It seems like every time financial news comes on, people are just obsessing over Federal Reserve Chairman Jerome Powell and whether or not there are going to be short-term rate cuts. But by focusing entirely on the Fed, we're actually staring at the wrong lever. The rates that truly dictate your life, we're talking the 10-year, 20-year, and 30-year yields, those aren't set by the Fed at all. As legendary investor Ray Dalio points out, the bond market is the basis, it's the backbone of all markets. It determines what all asset returns are going to be. Dalio is highlighting a stark reality here. Long-term bond yields are actually driven by global supply and demand. If the demand for bonds drops, the yield, or the interest rate, has to go up to attract new buyers. It's just basic economics, but man, it has monumental consequences.
And here's exactly why this is a uniquely American vulnerability right now. The United States runs trillion-dollar deficits annually. That's a lot of zeros. To keep the lights on, the U.S. Treasury constantly has to issue massive amounts of new debt. For decades, whenever the U.S. issued this debt, Japan was right there as a reliable, price-insensitive buyer, eagerly absorbing it to fuel their carry trade. But if Japan is stepping back, who exactly is going to buy all this debt? Well, this creates a massive domino effect right in your everyday life. Let's look at the stock market first. If long-term yields stay high just to attract those new buyers, stock valuations compress. Multiples drop even if a company's earnings are perfectly fine. Then look at mortgages. Because mortgage rates are heavily anchored to the 10-year Treasury, those rates stay stubbornly high, completely stalling housing affordability. And what about corporate credit? Elevated borrowing costs mean companies literally can't afford to expand. Deal flow slows way down, and capital tightens across the entire board. Long-term rates really do govern everything.
So the absolutely crucial takeaway here is this. The cost of money is changing everywhere. Traditional financial media largely ignores this incredibly complex truth because, let's be honest, it isn't a flashy, clickable headline like a shiny new AI chip or the latest political scandal. But the undeniable reality hiding just beneath the surface is that global liquidity, the very oxygen of our financial markets, is tightening up as Japan unwinds a 30-year megatrade.
Which leaves us with one incredibly vital question to ponder today. If the largest, most reliable foreign buyer of U.S. debt is officially stepping back and taking their capital home, who exactly is going to step in to buy the trillions in debt we issue every single year? And maybe more importantly, how high will interest rates have to go to convince them to do it? The entire foundation of the global market is shifting, and it is happening right in plain sight. Thanks so much for joining me on today's Explainer. Always keep questioning the consensus, and I'll see you next time.